Welcome back to another video. This will probably be our last time together as far as virtual through the video. This should be our last video for the semester, last video for the course. So how we're going to end this video series is we're going to do what I love, one of my favorite parts of the class. So the best for last. My favorite for the class are the financial analysis piece and the cash flow analysis, the cash flow statement. Now, we've talked about up to this point, we talked about balance sheet and income statement, and we've created the statement of cash flow, or excuse me, the statement of owner's equity. We've done that also through the class in previous videos. Those are three of the four main statements, financial statements. We have balance sheet, income statement, owner's equity statement, and cash flow. For me, as a finance person, the cash flow statement is the most important piece. It tells you where the cash is coming from and where it's going. And because cash is, that's right, cash is king. And because cash is king, it's very important. And that's one thing that is not emphasized in our business courses. And I'm not talking about just here with JC. It's not emphasized in business courses in the university level too. And every time I class I teach, I try to be very emphatic about the fact that cash is very important, and it is growing in the industry, but it's still a problem, and that's why businesses fail, because they say, oh, we're making money, but we're not collecting any cash. So, so we're going to talk about the statement of cash flow, or the cash flow statement. We're also going to do some analysis. Now, throughout the chapters, each chapter, except for the first few, we've been, the end of the last part of the chapter has been introducing some ratio or other that was related to the subject. We have inventory turnover, or DSI, days sales and inventory. We have accounts receivable turnover, or DSO, days sales outstanding, or ACP, average collection period. We've got the asset turnover, total asset turnover. We haven't talked about debt yet, but there's the debt to equity ratio, debt to asset ratio. So we're going to, the ratios that we use in a financial analysis is broken down to four main categories. And there's no particular order: profitability, liquidity, asset utilization, and debt. So profitability, liquidity, asset utilization, and debt. These are our four categories of ratios. So we're going to delve into them a little bit. I'm going to give you the formula. We don't have to go through any examples in this. That would be your homework for examples and application. I'm just going to give you the formulas. So what I've done for you is I've filled the board with a bunch of ratios. And this is not all of them. This is the most common ones that we use for financial analysis when we're granting credit or just analyzing the health and well-being of a company. And all we need is the balance sheet and income statement. In all these cases, just those two sheets. So, starting again with the profitability. Profitability obviously means how profitable are they making money. Not necessarily are they making cash, bringing in cash. It's, are they making money? So, remember, so the GPM stands for gross profit margin. And the gross profit margin is simply the gross profit divided by the net sales. Remember what net sales are. And you know that gross profit is net sales minus cost of goods sold. Net profit margin is the net income divided by that net sales, or revenue. If you don't know what the net sales are, revenue is good enough, income. ROE stands for return on equity. Sometimes you'll hear it as ROI. If you're listening to business news, it's usually it's mentioned as ROI, because equity and investment are very similar. The equity is part of equity. Remember that equity is divided into two parts. There's the stock or the capital, which is the investment from the owners, and then there's the retained earnings. So how much is the investment by the owners plus the reinvestment of that net income, that's the equity, what percentage of that is the net income? So how much of a return on, for $1 of equity, from $1 of stock I purchased, how much am I getting back on top of that stock in profit, in net income? We have ROA, which is net income divided by total assets. That's telling us how effective the assets are in generating the revenue or the income. Why? Remember back to the fundamental accounting equation. A equals L plus OE. And inside OE is the revenue and expenses in my hyper model. So profitability is directly related to and incorporated into the equity. So equity is on that side. Assets are over here. You can't do any business without an asset. You can't have a business unless you have a machine. You can't make anything. Or if you're a delivery driver, you need a car or a truck. If you're a lawyer, you need a desk, an office, and supplies and a computer. Those are assets. And those assets assist and are part of and the foundation for the business to generate that revenue. If you don't have that asset, you don't have that truck, you're not delivering anything. Therefore, you're not generating any revenue. So it's the concept behind it is the logic, the theory is that the assets are how the company is making money. So what is the asset investment related to the net income, the profit of the company? For every $1 of asset, how much profit did we get? That's this ratio right here. And then we have one, if they're publicly traded, if they have shares, then we have what's called EPS. You probably heard that in the business news, EPS, or earnings per share. That's the ratio here, and it's the net income available to shareholders divided by the number of shares outstanding. OS means outstanding. Those are, again, most of, not all, but most of the profitability ratios that we look at. But that only tells us how the net income, and in this case the gross profit, relates to other classes or other categories of accounts. Sales, equity, assets, stock. The next category we're going to look at is liquidity. That tells us how quickly the company can convert its current assets into cash to be able to pay its current liabilities or current debt. And you recall that current assets generally are cash, which is already liquid, accounts receivable, inventory, and your prepays and accruals. So your prepays are included in your current assets. So, what are we talking about liquidating? We mean turning things to cash. Well, in cash is already cash, so we don't have to worry about that one. Accounts receivable. Well, it's debt owed to you as a company, but you can call the customers and say, hey, listen, I'll give you 2% off the bill if you pay me now, or pay me in 10 days instead of waiting until 30 days. We talked about credit terms, and that will generate cash faster. Or pay me now, I want my money. You owe me, pay me now. I'm not going to wait 30 days. That's another option, and they will generally pay you. So you can collect that and convert the receivable to cash, because we have to credit receivable and debit cash when people pay us. With the prepay, if it's an insurance premium, you call your insurance agent and says, I want my cancel my insurance. What's the insurance agent going to do? I don't want coverage anymore. They're going to say, thank you for your business. Here's a check for what's called unused premium. And that's the premium not that you've prepaid that hasn't expired yet, as we did in our adjustments. You can go to the landlord and say, hey, I'm moving out, and they have to give you unused prepaid rent. If it's typically it's not in the same month that you paid it. If you paid May and you move out in May, you lose May. But if you paid 6 months from May, June, July, August, September, October, you can get 5 of those 6 months back if you move out right away in May after paying May rent. They owe you that money. So we can convert all those to cash, and including inventory. We can sell our inventory without making any more or buying any more. If you're a merchandiser, you don't buy any more inventory, you just sell everything, boom, everything becomes cash, and you don't pay in receivable. So what are we talking about current liabilities? Well, we're talking about AP, all those payables like wage payable that we talked about, income tax payable, all those payables, short-term notes. Those are our current liabilities that we can pay off. If we do all that, we have cash left over for other debt, the long-term debt. So how liquid are we is the relationship between the two categories, current assets and current liabilities. This typically should be about 1. It should be greater than or equal to 1. That would mean that if it was greater than 1, that means that the numerator is bigger than the denominator, which is good. If it's less than 1, we have a problem. The quick ratio, or sometimes called the acid test, is what if we have to do a fire sale and we have to get rid of all our assets? How quickly can we do that? Well, again, cash is already cash. We already said that we could probably get our receivables mostly, and we put pressure, we might be able to get all of it paid in cash very quickly. And there's a timing for it. We know when that cash is going to come in because they're going to pay with a discount or whatever. We know by timing when the insurance is, when we cancel our insurance, when that premium is going to be returned, the unused premium. Within days, maybe a week or so. We know from the landlord that we can generally within a few days we will get our rent back if we didn't do any damage. The one thing that's going to be a trick here in your current assets that you can liquidate is inventory. The problem with inventory is that inventory has a third dimension to it. It's not just the company and the customer. There is a marketplace, the economics. What is the demand for your product? If there's no demand, it doesn't matter how cheap you try to sell it, nobody wants it. So inventory is an undetermined time of how you can turn it. And it may not be able to be turned into cash. Again, it's dependent on the demand. So if we wanted to do quick fire sale, we can take out the inventory and then see if we still have a positive or greater than one number. This should be also greater than or equal to 1. It's called acid test because there's you could use acids to test metals. It was in the olden days, rich people, kings, those type of people would give a lump of gold to a goldsmith and say, make some jewelry out of this. And the unscrupulous goldsmith would not use the whole lump of pure gold, will use part of it and mix it with tin or some other metal that's just as heavy and would weigh or feel the same, but it's coated only with gold, and the inside core of that jewelry is tin. Even though by the human eye it still glistens, just like not all that glistens is gold. And if it's glistening looks like gold, it doesn't necessarily mean it is pure gold. And that's what you're expecting, and that's what you paid for. And that's what the unscrupulous goldsmith will take the rest of your gold and basically coat it or electroplate it so that it's got a coating of gold, but it's not solid. So there is an acid called muric acid, very ancient, back in several thousand years ago. We kind of discovered that muric acid reacts to gold, and it will turn a color if it's mixed with anything. And the amount of impurities versus the amount of gold, or other metals mixed with gold to will change it to a different color. Actually, gold is very inert metal, and it doesn't react to many different things. So that muric acid will stay clear. But if there's any other metal like tin in it, it will turn other different colors in response to the concentration of other metals mixed with gold. And tin being a silver and gold being gold color, that gold kind of overpowers any other color because it's such a strong color. So it's acid test. You drop a bit of acid on a small shaving, couple of shavings of gold, and it will still react or not, depending on the concentration of other metals. And we've also talked about the NWC, or the net working capital, which is the same as current assets minus current liabilities. Don't mind this for just a moment. I'll explain this box in a moment. So liquidity are basically current and quick ratios. Asset utilization stands for how effective our assets are, and how effective is the company in managing certain assets. Not all, certain. We have what's called the accounts receivable turnover. That is the net credit sales, which is sales minus sales returns and allowances and sales discounts. And then we break off and specifically talk about credit sales versus cash sales. So we take the credit sales, take out the sales returns and allowances and sales discounts, and that's our net credit sales. Not for cash, for that. And then we take what's called the average net AR. And average net AR is the beginning accounts receivable balance at the beginning of the year minus the AFDA, plus the accounts receivable at the end of the period, or the end of the year, minus the AFD at that point. That right there is our net AR. The average is adding those together and dividing by 2. And that will give us our average net accounts receivable. And that's what this denominator is and this numerator is. So that will tell us how many times a year, or in that period, mostly a year, are we turning our receivable? Is our receivable going up full and getting paid off completely? How many times does it go like this? Now, accounts receivable doesn't get full to a point and then it becomes completely zero. There's daily receipts coming in, cash coming in to pay bills, and we are billing more bills. So it doesn't ever come to be zero. But if it were, that's what the turnover is actually telling us. The ratio tells us how many times it's going from complete to zero and completely paid off. That tells us how many times we're really collecting 100% of our receivables over that period of time. So that's a very important thing. That tells us how effective. The smaller the number, the worse we are. And it could be, the industry is that way too. That's a different story. Total asset turnover is our revenue divided by total assets. And that tells us how effective, again, how effective are the assets. Just like with return on assets, it tells us how, for every $1 of asset, how much net income we're getting. For turnover, it's for every $1 of asset, how effective is it in generating how much revenue. The larger this number, the higher it is. So that's that total asset turnover. Inventory turnover is the cost of goods sold divided by average inventory, which is, average inventory is the inventory number at the beginning of the year plus the average inventory, the inventory number at the end of the year divided by 2. This will give us an average, a straight line average. And what inventory turnover tells us is how many times, or how many times in a year, or that period, are we building up our inventory and selling it to zero. Building up and selling it to zero. Similar to AR turnover. If it was possible to build up to a certain level and then completely get it paid, sold out to zero, and then build it up again, we can't go from 0 to 60 like a Maserati. It doesn't work that way in business. Things to go slowly. So there's constant sales out of inventory and buildup of inventory over time. So it's never, ever 100% to zero. It's always somewhere in between, constantly moving. Remember, it's a current asset. But the inventory turnover, like AR turnover, tells us how often we can actually sell it out. The higher the number, the faster or more often we're turning over our receivable. DSO stands for Days Sales Outstanding. That means how often, how long is it taking to collect? How long is those sales staying in the books? ACP stands for Average Collection Period. I believe the textbook uses the DSO, but if you use any other textbook or any other author or talk to anybody else, they may talk about ACP. Now, I like to say the DSO. Why? Because the DSO also stands for Detroit Symphony Orchestra, and I'm a musician, so I like to talk DSO. It reminds me of the symphony. So remember, what does DSO stands for? Yes, it stands for the Detroit Symphony Orchestra and Days Sales Outstanding. And the formula for that is the average net AR, remember how that's calculated, divided by daily credit sales. Daily credit sales are calculated by, watch this, our net credit sales divided by 365, the number of days in the year. And the DSI stands for Days Sales and Inventory. How long are we keeping our inventory warehoused somewhere until we sell it? So that is the average inventory, again, beginning inventory plus ending inventory for the year, divided by 2. And daily COGS is cost of goods sold divided by 365. That's simple. That gives us a daily amount. The last thing we have 3 more ratios over here for debt. We have debt to equity, that's the T, debt T equity is debt to equity. And it's really total liabilities divided by owner's equity. It tells us the ratio of liability to equity, and because both those sides have to be funded or secured by assets. Remember, to assets equals liability plus equity. Well, what is the relationship between the equity and the liability on this side, which must equal assets? The second one is debt to asset ratio. The debt to asset ratio tells us how much debt we have in relation to our total liabilities as related to our total assets, because our assets are securing that liability, or else we don't pay the liabilities, they take our assets. I said assets. And the last one we're going to talk about is times interest earned. You take EBIT and divide it by the interest expense. And that tells us how are we effective in collecting enough money to pay our interest off. Not just the debt, because debt is part of liability. But on top of that notes payable that we have, or long-term note that we have, or short-term note, we have interest. And that interest comes out of our income. And that's where that interest expense is. That's what that tells us. Now we come to my favorite part. My favorite thing to talk about is the cash flow statement. The cash flow statement is actually really the difference or the changes between 2 balance sheets. So you can't create a cash flow statement from just 1 year's worth of balance sheets. It's really the changes in 2 different balance sheets. So here we have our balance sheet in the fundamental accounting equation format. Assets equals liabilities plus owner's equity. And the assets broken down to current and fixed assets, liabilities that broken down to current and long-term liabilities, the equity broken down to stock, and retained earnings, the stock meaning, again, as I said, is the capital section. How does that relate? Well, the cash flow statement is actually three sections, three distinct sections. We have cash from operations, we have cash from investing, and cash from financing. Where does it all come from? Well, operations is your day-to-day business, what you're doing daily. And how do we analyze how the cash is changing from day to day to day that equals that year of the balance sheet? Well, cash, accounts receivable, prepays, inventory, accounts receivable, and cash all are directly related to our daily day-to-day business. We build up our inventory, we sell it on credit. We get paid for the bills. That's current assets. Current liabilities are our, to get those assets, to get that inventory, we have to buy it from our suppliers. And our suppliers will only gives it to us through our payables. We owe the money. So that's part of our daily day-to-day. Our wage payable, that's part of our day-to-day. As an accrual between two time periods, things like that. So both of those are directly related to cash from operations. And you see that's where they are right there. Both of these. Now, investing is not putting money in a stock, buying a stock with a company's money. That doesn't work that way. That's not considered an investment. In fact, in economics, we call that a saving. We're saving money by putting money in a stock. So that's not what we're talking about investing. We're talking about reinvesting in the company. And how do we do that? Well, to grow the company, we must take the cash and buy more assets, because the assets generate the revenue. Remember, we just talked about that in the ratio. Asset utilization, part of it is total asset turnover. How often are we using these assets to generate revenue, to generate sales? To get more sales, we need more assets. So how do we grow? We invest by buying more assets. Or, as we talked about, there's the acquisition of assets, but there's disposal of assets. And that's what the investment is we're divesting. So fixed assets directly relate to cash from investing. Now, if a company needs large sums of money quickly, it's going to go where? It's going to go to the bank. So if it's going to go to the bank, it needs large sums of money. That's going to be a long-term debt or a long-term liability. Or they can go to the marketplace and say, I'm selling stock and I'll get money. Or go to the stockholder and say, buy some more stock from me, company me, and I get more cash. So selling stock is part of financing. Now, there's a very, very, very important thing you need to know when creating a cash flow statement. Very, very, very important. When an asset increases, it's bad for cash flow. When a liability increases, it's good for cash flow. And if an equity piece increases, it's very good for cash flow. Let me explain. It sounds backwards. This is the part of that logic piece that's crazy with accountants. They're kind of crazy. But let me explain it to you. You buy a car for cash. That car is an asset, right? It's a fixed asset. It's going to last you more than a couple of years. But what did you have to do to get that car? Good looks? No, you went and got cash. Whether you financed it or had cash completely in your hand, you still had to get cash from a bank or from your pocketbook, but you had to get cash to give it to the dealer or to the seller of the car to get that. So the car represents an amount of cash that you had, but you exchanged that cash for an asset. So it's the same as if there's cash trapped in that asset, because you can dispose the asset. We saw that before. You can dispose of that asset, get rid of it, and get cash for it. So the asset, you have to use, you need cash to acquire it. If we talk about accounts receivable is money owed to us but not cash, because we billed out to our customer, they owe us money. When they pay us, then we are exchanging that one asset for another, meaning that owed money for cash. So it's cash. The accounts receivable, even though it may be going up, that's cash trapped inside there, and we can't get it out until we actually sell it or collect on it. So assets going up is bad for cash flow. It's good for a financial statement because you want to see that going up. And we see that if fixed assets are going up, that's a good thing. But when you do your cash flow statement, if an asset is increasing between the two balance sheets, it's going from 500 to 700. You've got a receivable 500 in 1 year, it's 700 in the next year. That's going up. That means more people owe you money. That's cash. That's $700 or $200 of cash more trapped inside there. So that means that's a $200 negative cash, meaning a negative or a reduction in cash. When liabilities go up, if you owe somebody money and don't pay them, where's the money? Where's the cash? If you owe somebody cash, money, and you don't pay them, what happened to the cash? It's still in your pocket. And if it's still in your pocket, that's cash that you have. You could go do something else with it and not pay that. So, and liability is, if the liability is increasing, it means that we're holding on to cash, not trapped cash. It's the actual liquid cash we're not using to spend on that liability, so we borrow a little bit more. That's more cash that we have in our hands. Not that we've been paid cash. That means that we've retained more and haven't used it. So that's when a liability goes up, that's good for cash flow. Now, equity is, if we sell stock, equity is going to go up. When we sell stock, in exchange, we get cash. So if an equity piece goes up, that's good for cash flow. Okay? Now that you've understood some of the ground rules of how the cash flow works and kind of backwards, and what part of the income statement this comes from, let's dive into this a little bit more. So this is the basic form, and this is what you have to do. These are the steps you need to do to come up with a cash flow statement. First and foremost, the very first thing on top here is the net income. That comes directly from the bottom line of the income statement, or the P&L. The next thing we get is we add back in depreciation and amortization. When it comes to the depreciation, we went through three main ways of doing depreciation. There's depreciation expense, but when we write out that depreciation expense check, who gets it? Who's on the payee line? No. Nobody. Nobody gets a check when you do that depreciation expense. It is an accounting function, but there's no cash going out. Since there's no cash on that expense, the net income, which is net of depreciation, amortization expense being taken out, we add it back in because there's no cash. That wasn't cash, so that amount wasn't part of cash. We didn't pay anybody. It's just an expense. Then we take a look at the current assets. We look at not cash. That's the only thing we're not looking at with this current assets, because we're talking about cash here. So we don't look at the cash difference. We will in a second. But we look at the difference in accounts receivable, inventory, the prepays, other accruals that may be in the current assets. And if it's going up between the two periods, then we're subtracting it. It's bad for cash flow. If it's going down, that's good for cash flow. We'll add it. When it comes to current liabilities, we'd look at the AP between two periods. And if it's going up, that's good for cash flow. We'll add it in. If it's going down, it's bad for cash flow. We subtract it. So that's why it says plus or minus. Depends on whether it's going up or going down. We add or subtract whichever numbers we have here, and we get what's called the cash from operations. And hopefully that's a positive number, because that means that operations is a positive function of the business. But if it's negative, it's bad. And that means cash used in operations. That's a bad thing. The next thing is whether we acquired more fixed assets or did we dispose of fixed assets. If we dispose of fixed assets, that's good for cash flow because we must have gotten cash for it. If you sell a car, you're going to get cash. If you buy a car, you're going to use cash. So cash goes down, your asset goes up, which is the new car. If you sell a car, you're going to get cash for it. So asset going up, it's bad for cash flow. So if we're acquiring fixed assets, it's a bad for cash flow, we will subtract it. But if we're selling or disposing of assets, that's positive, that's a good for cash flow. That means cash from investing. Cash from investing activity. The third piece, the third section is whether liabilities are going, long-term liabilities are going up or down. If it's going up, it's plus. If we're paying down debt, which is a good thing, it's bad for cash flow because you need cash to do that. Changes in stock, whether we if we sold stock, that means that the stock part, whether it's common or preferred stock that we sold, we have the par value of the common stock plus the PIK. And that is what goes in here. The amount that we bought or sold it for, the par value plus the PIK, the paid in capital, that's what goes here as a change. So if it's going up, that's good for cash flow. And dividends, if we're paying dividends, and that's a big if there's a dividend that's paid, declared and paid, that's cash going out. So it's always subtracted. And that gives us our cash from financing. Now that we have these amounts of cash here, here, and here, what we do is we put it all together. We take our cash from operations, add or subtract, depending if it's positive or negative, the cash from investing and cash from financing, and what we get is what's called net cash. That's the net cash for that period. We add in what was the beginning cash that was in the first. Now we look at the cash, and we go back to our two different balance sheets, and we take that amount from the balance sheet and stick it here, add these two together, and that should be the ending balance. And if that amount should equal the other cash line from the second balance sheet, the one we're comparing to, one to the other, 1 to 2. And that's about it. This is the end of this video, and this is the end of this video series in Accounting 231. I hope you enjoyed it. Please let me know if you have any questions. I welcome all the questions. I want to wish you all the best in the future. Good luck to you all. And if we ever meet again, and I hope we do meet, it's distressing to me, I'll be honest, that we have to do it this way. I will never have met you unless there's another class that I do teach, and I have the pleasure of seeing you then. But I wish you all the best of luck on not only the exams that we have, the midterm and the final that you have gotten by now, all the quizzes that you've received, all the homework that you've done. I wish and I hope that you've got something out of this that you can take with you when you graduate from JC and you graduate and you go to the university and transfer to university. Thank you very much.